Bloomberg Audio Studios. Podcasts, radio, news. You're listening to the Bloomberg Intelligence Podcast. Catch us live weekdays at 10 a.m. Eastern on Apple CarPlay and Android Auto with the Bloomberg Business app. Listen on demand wherever you get your podcasts or watch us live on YouTube.
So stay with autos for just a moment. Craig Trudell is Bloomberg Global Autos Editor and joins us now. Craig, at the same time, we also got the news that Tesla's estimates were cut further by an analyst on, quote, unprecedented brand damage. What's the conversation, the zeitgeist around that right now?
I think over here in Europe, it's particularly bleak when you look at some of the numbers. Just yesterday, we saw the full figures for Tesla in Germany in the first quarter. For them to have some months in the beginning of this year where they were down more than 70%, and that's in a country where they build vehicles, where you would think that they would perhaps have built up some goodwill on the basis of employing quite a lot of people outside of Berlin at their factory. And yet for Musk to sort of intervene in the federal election in February in a way that was highly unpopular, and for some of the protests that we've seen across the U.S. to also, carry over here, where, we've seen dealerships get, paint tossed on them, cars, set on fire. It's really intense, the backlash that we've seen against Musk.
So, Craig, I'm trying to get a sense how much of their sales weakness is due to some of that backlash against Elon Musk versus maybe some of the Model Y introduction and the change over there of lines. Do we have any sense as to what's, kind of the percentage between those two?
It's really difficult. I think we are going to be spending the next, probably months, maybe quarters, unpacking what exactly the dynamics are here, because, to your point, they did have a sort of, self-inflicted disruption that I should point out is not unusual in the auto industry. Even very experienced, car makers, when they go from one generation of vehicle to the next, they often need to do some retooling and take the factory, down a bit, work on the production lines. Tesla, in this case, had to do that at all of its factories around the world because they make the Model Y everywhere. And, so that was a substantial disruption for them in the first quarter that we shouldn't sort of lose sight of. I do think that, it can't be a coincidence that in a place like Germany, where you've seen Musk poll so poorly, and where he so asserted himself so emphatically, you look at those figures, and even as you've seen some weakness for Tesla in other parts of Europe, we haven't seen it be as drastic as we've seen it in Germany. So I think, to your question, I think there's absolutely a bit of both, and it's going to take us probably some months, maybe some quarters, to sort out, just how much sort of lasting damage has been done here, and whether they can lure buyers back with this fresh product.
I have to say, you look at, if you do Tesla equity in the DES, you get all the good information on Tesla right away. You look at a PE ratio, is still 112 times. You look at the PE ratio of NVIDIA, and it's 32 times, just meaning that it is still incredibly expensive when you look at it from that metric. Hey, Craig, really good perspective. Thank you so very much. Craig Trudell, Bloomberg Global Autos Editor, joining us on the overall impact of tariffs, but really brand reputational damage when it comes to Tesla. Wow. Yeah. This is a week.
You're listening to the Bloomberg Intelligence Podcast. Catch us live weekdays at 10 a.m. Eastern on Apple CarPlay and Android Auto with the Bloomberg Business app. Listen on demand wherever you get your podcasts or watch us live on YouTube.
One of the things we want to do on this Bloomberg Intelligence program is talk to the analysts at Bloomberg Intelligence and talk to us about their sectors. Let's do that right now with Herman Chan. He follows the regional banks for Bloomberg Intelligence.
I was going to say, it's never good when you see him in studio because it always, something is going to be blowing up in regionals when we see Herman. Otherwise, when we ignore Herman, it's like, everything is fine. Economy's great.
Everything is good. So how do you view from the bank's perspective, a world where it seems like we're in a trade war here?
Right. Well, banks are ultimately a reflection of their economies that they operate in. And when the economic expectations are in flux, then typically there's some pain for the banks, and that's where we are today. While all the bad news has been reflected in the stocks, the fundamental performance is still sort of shaking out. I would say that we're coming up on first quarter results in the next couple weeks. And so we'll get a better picture of guidance changes, performance going forward. But right now, we're still waiting to see where the shoe's going to drop in terms of loan growth, credit quality, et cetera.
And that's my question, because I understand the big banks getting hit in part because the capital markets are just going to freeze up. Like, forget IPOs, M&As, we're going to put that on the side. Okay, that kind of makes sense. But the regional banks may not have the same kind of exposure, right? And the real economy, the hard data, is still fine.
Right.
So were you surprised at the extent to which your sector got hit?
Every time there's worries about the economy, these bank stocks sort of get hit first, and then investors ask questions later. So that's where we are today. Valuations have come down, and there's just a lot of worries about future credit quality, the guidance coming down, loan growth, fees coming down, top lines coming down. So there's going to be a lot of revisions going forward if these tariffs do really materialize.
So I guess one of the things we're hearing, and we've heard it, all year as we were building up to this tariff date, now it's just kind of reflected in the financial markets. It's just, I just don't feel like doing anything. If I'm a CEO, I don't want to buy a company.
Right, totally.
If I'm a consumer, I don't want to make that big expenditure for the washing machine or the car or whatever. And that means I probably don't need growth capital.
Right.
So if I'm a bank, I'm probably not writing too many loans these days.
Exactly. And that's actually been happening over the past few years, given the uncertainty with interest rates first and then regulation under the Biden administration. There was just a lot of demand that was just on the sidelines, and you've seen that reflected in loan growth for the industry. It really hasn't moved a lot over the past couple of years, and the expectations heading into this year was that Donald Trump and the administration was really going to unleash more activity from a deregulation, but now the trade spat and just the chaos that's happening over the past couple of days, everything's really continues to be on the sidelines.
So I'm thinking any kind of like regional M&A that we've all been expecting for the last couple of years, that's not going to happen.
Or the banks, right?
Right, exactly. There has been some news that the Discover Capital One deal could be pushed through with the DOJ giving the green light to that. So now we're waiting on the Fed and other bank regulators to weigh in. So that could be a good litmus test going forward, but still there's a lot of uncertainty involved.
When you see an economy slow down like it appears the U.S. economy is doing, where's the first place you see it from a regional bank? Is it credit quality? Is it slowing loan growth? Where do you see it first?
Yeah, well, it's going to be slowing loan growth, and it's going to be sort of the delinquencies, right? So these 30-day past due metrics, 90-day past due metrics. So those will start trickling in. And then there's other early warning signs for credit quality that the banks talk about. There's some, in bank parlance, it's called criticized loans. So loans that may not be past due yet, but the bank knows that there's some problems with the borrower or the project, so they'll flag it as a potential problem. So those are sort of the metrics that we look out for every reporting season.
Which banks in your coverage are pretty well set up to manage this kind of environment right now?
Yeah, I think the market is telling you something. We just put up something on MRR looking at the 5-day performance of the KBW index, and it shows the trust banks like Bank of New York Mellon, Northern Trust holding up fairly well. M&T and PNC are the ones in my regional bank coverage that are holding up fairly well. And then there are others, smaller regionals that are faring worse.
Hey, can I just bring some breaking news to you?
Yeah, please. Yeah.
The NASDAQ 100 just entered a bear market, down 20% from its peak. I know it's just numbers, but
no, I mean, a bear market, we haven't talked about a bear market in quite some time.
But they're numbers, but they're also headlines.
Yeah.
That's part of it too.
It's people's IRAs and their 401ks.
I'm not looking at that. Who's looking at that? Any of you guys look at that?
No, I'm not looking.
I'm not looking.
It's now called the 101k.
I'm not looking for 20 more years. Just gonna sit there, and that's the story. Okay, and then before we let you go, real quick, Herman, what is like sort of the type of bank that's going to struggle the most?
Yeah, it's going to be the banks that have still been dinged during the prior regional bank crisis. Probably they'll be in the headlines still. So yeah, the banks that have sort of weathered it, but there's always that recent history that all investors point back to. So banks like Western Alliance and others that were sort of teetering during that time probably get pushed a bit more by investors, but we think that their balance sheet and the deposits are really strong going forward.
All right, Herman, thanks a lot. Really appreciate it. Herman Chan joining us in studio. Always good to get your perspective.
You're listening to the Bloomberg Intelligence Podcast. Catch us live weekdays at 10 a.m. Eastern on Apple CarPlay and Android Auto with the Bloomberg Business app. Listen on demand wherever you get your podcasts or watch us live on YouTube.
All right, let's go now to tech and where we are in that market after the big sell-off. Anurag Rana, Bloomberg Intelligence Senior Technology Analyst. All right, Anurag, what stops the bleeding here for tech?
We need a few more of those announcements that other countries are willing to negotiate as well, because unless that happens, it'll be very tough to figure out where the bottom is in terms of fundamentals for any of these companies.
Yeah, Anurag, we had Dan Ives in studio early this morning on surveillance, and it's by far the most cautious I've ever heard him. Now, granted, he's a very bullish analyst by nature, but he's saying basically this is a black swan event for technology, and unless it changes, this is a long-term headwind for tech. And I guess that kind of goes, and he even went to the level, Anurag, of saying he'd be surprised if many of his companies even provide guidance in the upcoming earnings here. So as you talk to clients, what's the mood out there? Is there anybody saying, I feel the bottom here, these are great companies, I can buy them cheap here? Or what are the conversations like?
I think the biggest thing is how long is this malaise going to last on the uncertainty side of it? Because, frankly, if you extrapolate and see what NASDAQ has done over the last 3 years, it has been phenomenal since ChatGPT came out. So, one could argue there is a lot to give on the price action point of view. But fundamentally, these are very strong companies, really amazing balance sheets, and also the growth profile down the road. And, we talked about the conference, and everybody is looking to invest more in more AI related services. So the fundamentals on paper are very good. But what happens is when you have a shock in the system like this, everybody freezes. Hiring freezes, spending freezes. So you don't know what to do for the next 6 months. You don't know whether the revenue decline, how much is it going to be? The margin, pressure because of the tariffs. So there is so much uncertainty right now, and I think there's a fair point that the guidance is going to be very tough at this point.
Oh yeah, tough for everyone. I should point out some more headlines coming out of President Trump saying it's a perfect time for Fed Chair Jay Powell to cut rates. This is as Jay Powell is expected to speak in just about 20 minutes time. That's going to be a fascinating conversation to unfold. That's pretty tough. Okay, Anurag, when we take a look at earnings estimates for these companies in your tech space, in what subsector do they need to re-rate more?
I think software numbers needs to come down quite a bit, and something we did a note a few days ago. We looked at the top 50 software companies and saw that the median growth rate for those was 13.2% on December 31st. So that is for for calendar year 25. Just a few days ago, that number was 12.4%. So less than 1% decline in the expectations of a growth rate. That number needs to come down quite a bit. It needs to come down, well under 10% at this point before one could say that, okay, we are at that point where fundamentals are now aligned with where the overall economic situation is.
So let's go down and talk about Apple here. It's off another 3.6% today, off 21% year to date. Anurag, is there any call here on Apple? They're just so, and we've known this for years, and we've talked about it for years, how so dependent they are on China, both from a supply chain as well as an end market. What's your current view on China in this environment, on Apple?
Yeah, I'm really getting worried about how how consumers will react in China with this thing. Because, it's one thing to say that, okay, my phone buying has been pushed out by 3 months or 6 months or so. Okay, the demand comes back next year. It's not that big of a deal. But once you really get a bad feeling about a company or a country, that sourness really impacts the fundamentals of it. We have seen what's going on with Tesla in Europe, for example. You don't want Apple to have that same feeling in China where consumers are saying, what, I don't want to touch an American brand. I would rather just buy the local one. And that's a very big problem in our view, because Greater China region accounts for 20% of Apple's revenue.
Yeah, and this is what we're talking about now. We're not even talking super cycles anymore. I feel like 6 months ago it was like, no, it's coming. The next iPhone super cycle. To that point, we've already seen, say, Ford talking about discounting their cars to get people in the door. Is this going to be a similar case for Apple? Because they're not a discountery kind of thing.
No, I don't think so. I mean, I think the Apple CEO has played it very well when it comes to China. He has gone to China a few times. He's been seen with the commerce ministers. He's talking about investing more money here and there. And I think he's playing the cards right, because you really don't want the world's, most lucrative market for your goods to basically have a very bad feeling about your products. Because at the end of the day, in the US, they really cannot grow much. It's a saturated market for them. Their growth rate will come from emerging markets, whether it's China or in a few years from India. But, they really have to play it nicely in China in order to show growth rate over the next 3 to 5 years.
In terms of overall tech spending, Anurag, how elastic is tech spending broadly defined? Is it something that these companies feel like they have to do no matter what? Or like advertising, we're just talking to Geetha Ranganathan, that is very discretionary spending on a part of a company. How about tech?
I think you divide it in two categories. One is your growth capex, where you're going to invest for newer products. And that will remain the case. AI spending, let's say somebody is spending, $100 more, they will probably spend $95, $100 again. That's okay. But the problem comes in, now it comes at the expense of something else. You are going to upgrade the PCs in your department. That's not going to happen. You're going to push it out by 6 months. Servers, normal software that you use for day-to-day work. You're going to scale back on some of those elements. Consulting, is off the window at this point. I mean, I'd be very surprised to see consulting. One could expect layoffs coming in the consulting world over the next, few months, because if there is no work, these companies are going to cut out consultants, whether it's McKinsey, BCG, or some of the other services companies. So you have to take money out from one to give it to the other.
But that's what I'm saying. Is it a rotation of money or just a non-spend of money altogether? Like, does one section spend more while the other spends less? Or is this a true pullback?
It was a mix of both. I think reallocation is definitely going to go, but I don't expect, if somebody is investing in AI to improve their operations, they're not going to stop that project. But to be very frank, that number as a percentage of total spending is still not that big for a large bank or a retail company. It's really the day-to-day work, and that's where you're going to see. Anticipating more layoffs coming in over the next 1.5 months from some of these vendors.
Oh, man. That is a grim prediction on that point. How fast do you think spending could pick up? Like, what would be a trigger for a reset?
The news like Vietnam, please give me 5 more of those news releases and all of this turns and everything goes back to normal. Because frankly speaking, we are really on a thin line when it comes to business confidence. And I think really in our view, these things are really, they're playing with fire, because once it takes the spiral downturn, it's very difficult to stop it. So if it stops over the next few weeks, I think we can see a good end to the year. But otherwise, once the layoff starts, then it's a vicious cycle.
So is there any safe names in tech? I mean, is Microsoft the safe name?
That's a very good point, Paul. We have been thinking a lot about it, and discussions we have been having, and with folks like you, we've been saying that companies that are really exposed to the large enterprises, so the Fortune 500 companies or the Fortune 1000 companies, they will be less impacted than the ones that are impacted to the SMB spending. So I'll give you a very good example here is Shopify. Look at how it's completely been, decimated yesterday and today, because bulk of their consumer base or the client base is small and medium businesses. Now, somebody like a Microsoft or a Workday that deals primarily with larger companies and larger enterprises, a lot less, disturbance in their revenue flow. They will also get hit. It's not that they're immune, but it'd be a lot less than somebody like a Shopify.
I also have to wonder if does this change the ROI for AI, for example? Like, you got to prove it harder and faster in this kind of environment.
See, one of the things is that's still in the experimentation state. So let's say if a company, if a bank is spending $100 in technology spending, in total, they're not spending more than $1 or $2 in AI. So it doesn't really, that doesn't move the needles. It's really the bulk of the big hardware purchases, big computer purchases. That's the one that, gets pushed out.
All right, Anurag Rana, thank you so much. We appreciate that. Anurag Rana covers all the technology for Bloomberg Intelligence, joining us from Chicago via Zoom here.
You're listening to the Bloomberg Intelligence Podcast. Catch us live weekdays at 10 a.m. Eastern on Apple CarPlay and Android Auto with the Bloomberg Business app. Listen on demand wherever you get your podcasts or watch us live on YouTube.
What we've been trying to do is kind of go industry by industry and see what potential impact could be on a world where there are much higher tariffs in most of the world. One of the areas we want to look at now is the media business. It is a global business, and for that we go to Geetha Ranganathan. She covers the media industry for Bloomberg Intelligence. Geetha, I mean, I guess, where do you see some of the risks to some of these big media companies, to their business, in a world that appears to be going through some type of trade dislocation, to say the least?
Yeah, sure, Paul. So I think in general, what we're seeing is, of course, a lot of these media companies are heavily exposed to advertising, television advertising, and television advertising has already kind of been a little bit down in the dumps. And overall, we're seeing, kind of consumer confidence shaken up pretty badly. And with that, we're seeing ad projections. So growth projections actually come down by quite a bit. So before all of this stuff started, Magna Global was projecting about 5% increase in U.S. advertising spend for 2025. Now it's down, actually before the tariff news, it was down to 4%, and I suspect it could go even lower. So that is going to be a big blow to the bottom lines of a lot of companies like a Warner Brothers or a Paramount.
So let me just ask a stupid question for you two smart media people. So I'm Nike. I usually do advertising, say on CBS. I'm making all of this up, right? All of a sudden I'm like, oh my gosh, I'm not going to be able to sell my product, so I'm going to pull that ad all together. And is that like the logical 1 + 1 + 1 = 3 trickle down, Geetha?
That is exactly what it is. We have seen, it's great that you brought up Nike. We've seen commentary from a lot of these consumer-facing companies that are saying that they are going to pull back on advertising quite a bit this year. And that's really just a way of them protecting their bottom line. So we're seeing that commentary actually across the board. We're seeing even, digital advertising. And remember, digital advertising has kind of been the standout, has been the star of the show, if you will, for so many years now, jumping up every year about 15 to 18%. And we've seen some pretty soft commentary even for digital advertising. So I think across the board, there's definitely a lot of nervousness.
How about, I think about the Walt Disney Company and even Comcast, the theme park business, which has been such a great business it's been a great business just across the board, and Disney's really stepped up its capital spending for that business because they're so bullish on it. But if consumer sentiment is shaky here, is the expectation that they'll see it in their top line?
I think so, Paul. I think this is going to be a real risk for Disney. Remember, this is so important for Disney. Parks make up 60% of the company's profits, so absolutely critical to their bottom line. Now, what management did is they already guided to 6 to 8% profit growth in the theme park business for this year, but I think they might have spoken too soon. So we've already kind of seen a little bit of softening in terms of theme park trends, and I think it's going to get even more and more difficult as kind of the year progresses. Disney also faces some competition from Comcast, actually.
Yep.
Because Comcast is opening Epic Universe on May 22nd. So for Disney, it could almost be like a double blow here.
Which is so weird, because weren't we saying just like a couple quarters ago, oh, it's great because it's like a one-stop shop. You get to go there, you're going to Universal or Comcast, but you're going to go to Disney at the same time. Now that's not the case.
Not the case, because again, there's going to be a lot of pressure on consumer wallets, and we've seen some really clever pricing come out of Comcast. So the way that they're packaging their promotions for Epic Universe is it's a 3 or a 4 day package, leaving a family like very little time to go to Disney. So they know what they're doing.
Is there going to be an analyst day for this new theme park?
Not that I've heard. I haven't heard.
See,
of
that's
that.
what Comcast and most other companies don't get that Disney gets. Disney, whenever they do something fun like a new cruise ship or open up Shanghai, they have all their investors and analysts come, and it makes everybody feel good, and presumably that's good for your stock, and they know how to play that game.
Is that kind of like a bribe?
Yeah, but it's fun. They used to be really...
Yeah, and what's your point?
Sorry.
All right, Geetha, thank you so much. We appreciate that. Geetha Ranganathan for Bloomberg Intelligence. The best one of those I did was in Canadian National, opened up their tunnel through one of the Rocky Mountains that cut the transcontinental trip by like 50%. We had a multi-day rail trip through the Canadian Rockies. Awesome.
This is the Bloomberg Intelligence Podcast, available on Apple, Spotify, and anywhere else you get your podcasts. Listen live each weekday, 10 a.m. to noon Eastern on Bloomberg.com, the iHeartRadio app, TuneIn, and the Bloomberg Business app. You can also watch us live every weekday on YouTube and always on the Bloomberg Terminal.